Hello, folks. My name is Mark Blinderman. I'm a registered investment advisor and managing partner at Walnut Investment Services in beautiful Park Slope, Brooklyn. And this is, I guess, a pilot show, something that I hope to do every week to enlighten, educate the investing public. Share with you a little bit of my experience with investing and managing money, whether you do it for yourself or for other people, family members and such. During the weekly, hopefully weekly broadcasts, I will discuss various topics pertaining to money management and investments and retirement planning and such, as well as just general discussions about economic conditions in our country, around the world, and how they impact your everyday investor. This show I want to start with a subject of common mistakes that investors make, and of course there's probably quite a bit of those. But the most common ones tend to run tend to be pretty equal, I guess, among the investing public. In that it's the kind of mistakes that we all make. Yours truly is also guilty of them, at least in my early days. And so I just want to impart a little bit of experience and wisdom on this subject. So to begin with, one of the most common mistakes that people make is they don't start early enough. I cannot overemphasize the importance of that mistake, in the sense that most people who are in their 20s or 30s rarely think about investing for the future. Telling a 25-year-old that he will need some money, some serious money to retire when he's 65 is an abstract concept to them. Most people that age have trouble seeing a year ahead, much less 40 or 50 years ahead. Nevertheless, numbers speak for themselves. Case in point, if you had $10,000, for example, that you invested and left to earn, let's say, a common rate of return, historical rate of return in the market of, let's say, 8% per year, and you left that money for 40 years. At the end of the 40 years, assuming you're not contributing any more dollars, just that original 10,000. That original 10,000 in 40 years will become over 200,000. I think approximately $220,000. Now, if you start doing the same thing, in other words, took the same $10,000 and invested it 10 years later, giving you only a 30-year time horizon instead of a 40, that $10,000 would only become 100,000. Okay, so obviously you could see the disparity between those two numbers and what a difference just 10 years make. Now, of course, if you contribute money each and every year over the course of that 40 years, then your nest egg will grow so much larger. So this is something that I cannot overemphasize. The earlier you start, the better. And usually a good approach is, for instance, to just set aside a little bit of money into an investment account. It doesn't have to be anything elaborate. There's plenty of mutual funds out there, ETF, index funds and such, that you can invest and let it just grow and make regular contributions to it year after year. Of course, if you in a position where, let's say, your employer offers a 401k plan, right, a pension plan of some sort, okay, you really should take advantage of it. Not only it's a lot easier to do when you have X amount of dollars automatically taken out of your paycheck and deposited into your investment account, a pension account, but also there are tremendous tax advantages involved. You're working with pre-tax dollars. So every dollar that you contribute into such a retirement plan, whether 401k or an IRA account, you immediately make money without even investing it yet, simply by virtue of the fact that it's pre-tax dollars. So that is definitely something you should take advantage of if your current employer offers such opportunity. If you're self-employed, the possibilities for you are even greater because the variety of pension plans that are offered to self-employed individuals is a little bit wider. There are more choices to pick from, and contribution limits are also much higher. So do that, and do that and start now. Okay. Another second common mistakes that investors make, and I'm sure all of us have heard this more than once from more than one source, and that is putting all your eggs in one basket. Okay, so this concept kind of speaks for itself, and essentially it means that you really should not be investing all of your money into any single type of investment. So the key here is diversification. No matter how small your account is, no matter how little you contribute every week or every paycheck or every month, whatever your situation might be, okay, you do have to try to work on diversifying your portfolio so that it is not concentrated in any single field and doesn't get impacted by let's say a serious market correction where that particular investment is affected. So if you have all of your money sitting in let's say high tech or real estate related investments, you don't really need an overall market correction to suffer serious losses. All you need is a big decline in that particular sector. So if the technology sector takes a dive, obviously you will feel it. However, if your portfolio is diversified, it will mitigate that decline because other sectors might compensate for the losses that you've suffered, let's say in the technology field, and or any other. So the key ingredient here, of course, is diversification, and it's a proven notion. It does provide certain safety features to that. Another common mistakes that investors make is, like I said, going back to my first point, they don't maximize their contributions. If you have the opportunity to contribute to retirement plans, then you should try to maximize it as much as possible. Not knowing what your financial situation is, I mean, we all have bills to pay and such, but if opportunity is available to you where you can take advantage of the maximum allowable contributions, seize that opportunity. The next common mistake that investors make is what I would simply call falling asleep on the job. Okay, I've been involved in this industry for over 15 years now, and it's hard for me to imagine how anybody in this day and age, with all the information and plethora of information sources that are available, would not take the time and the effort to investigate their investments, to monitor them, to make the necessary changes. Now, granted, all of us are busy with our lives and our careers and and other responsibilities in life, it's entirely possible that people simply don't have the time or the wherewithal to handle these things. In which case, they tend to use services of professionals, for example, like investment advisors or financial planners, to help them along. But regardless of who's actually watching over your portfolio, it is important that somebody is watching over it. The market dynamics have changed, unfortunately, in the sense that where your grandparents or maybe your parents were used to just kind of buying an investment, a stock or a mutual fund, and forgetting about it, and kind of just leave it lying there on the shelf, being comfortable with the knowledge that over X amount of years it'll just keep growing and growing and growing. That might still be the case in certain things, but it's not the case in general anymore. Like I mentioned, the market dynamics have changed, and there is a much wider variety of investments available to people today than just 10, 15, 20 years ago, not to mention 40, 50 years ago. So while you may think that you have a very well-constructed portfolio consisting of good names, good companies, and so on and so forth, it is still absolutely necessary that you watch your investments. The next point I wanna discuss is probably has to do with doing what other people are doing. That's a pretty common mistake, and it's human nature, I suppose, for us to kind of just watch the successes of people around us and thinking that what works for them would work for us. Nothing could be further from the truth. In the investment world, just like in anything else in life, there are different strokes for different folks, so to speak. What might work for me doesn't necessarily work for you. I personally, as an investment advisor, manage money for individuals from all walks of life, all ages and statures and incomes and so forth. And it's very rare that that I find that I can apply a single investment formula for all of them. So I do micromanage, and each investor receives individual attention, and their portfolio, their investments are structured to meet their specific needs. And it's based on various criteria having to do with that individual, whether it's their age, their risk tolerance, their income, their other assets. So don't automatically assume that if Joe Smith is having great luck in the market, that if you simply do what he does, you will have just as much luck as he does, assuming that he does. Okay, moving along, and I think probably this would be the last point that I want to make. I cannot overemphasize that point, and it has to do with trying to time the market. I'm sure we've all heard that term, and I'm sure there's plenty of pundits out there who claim that they've done this so well and they've predicted that, and they've anticipated a crash in the market, or they predicted the rise or the fall of the price of oil or the price of gold, and they moved in and out just in time to seize the opportunity on the upside or the downside. Okay, now without judging anybody, I'll tell you this much. There are very few, from my experience, very few people out there who are ever able to predict the market directions. It's more of a crapshoot. It's more of a situation where somebody called predicted, let's say, a move in the market or in the stock or in the price of oil and the price of gold, and it actually happened, I assure you, it was not because this person had crystal ball. So don't chase the latest fads. Don't necessarily accept recommendations of friends or colleagues or relatives, because remember, people will always be happy to talk about their successes, and rarely, if ever, they will tell you about their when things go the other way. So formulate your own plan, do your own research, talk to people. I don't have a problem with that. Get some professional advice if you have to, but don't think that you know which direction the market will take. I mean, the market obviously has its own dynamics. It has ebbs and flows. There are certain patterns that exist in the market which are easily identifiable. So you can't call them predicting the market. You just know that at certain times of the year, certain things do better than others because of seasonalities or particular dynamics of that industry that you're investing in. So research all of these factors, formulate what you think is best for you. Okay, make commitment to contribute to your investment accounts, whether just regular investment accounts or retirement plans. Stick to your strategy, be disciplined about your approach, and I think you can pretty much call yourself a successful investor. So with that in mind, I'll conclude our first hangout, and I hope you were able to gain some valuable points. I'm sure I'm not the first one who have discussed these issues before, and good luck until we meet again. I intend to hold these hangouts every Wednesday at 5 o'clock Eastern Standard Time, and over time I will hopefully have some guests and other participants, and I also plan to introduce the Q&A format, so if anybody's participating and participating in the hangout directly, can address address whatever questions they might have. I'll try to answer them to my best ability. So until then, have a great day, and looking forward to meeting you next week.